Welcome to the Deep Dive. Today our mission is, well, pretty straightforward. We're tearing through a whole stack of sources on a figure known in Japan simply as BNF.
You might have heard him called the god of Japanese day trading.
And it's not really an exaggeration. But what we're unpacking here is a true paradox.
It really is. I mean, here's a guy who amassed billions, got the attention of titans like Masayoshi Son.
Who is a billionaire himself, we should add.
Right. And yet, BNF's whole operation was the complete antithesis of professional finance.
Absolutely. The sources paint this incredible picture. He's managing billions from a tiny apartment living on cup ramen and anime, and his setup is completely unprofessional.
But that wasn't an accident. It was intentional. That lifestyle, it came from this really deep-seated distrust of the entire financial system.
And that distrust became his superpower, in a way. So the core question for you, listening, is how did a broke college student with, basically zero resources?
And facing the most brutal bear market in modern history.
How did he create strategy so powerful they let him make around 2 billion yen in a single trade?
The JCOM trade. We'll get to that. This is the story of his goal, to become the world's first billionaire bare bedroom day trader.
Okay, let's start at the beginning. BNF was born in Osaka in 1986. And for a while, he was just sort of drifting through college, not doing much.
A classic story. But then in 1998, he has this catalyst, this moment of inspiration. And it came from, of all places, television.
Yeah, he was watching this NHK finance series, and one specific episode just changed his world. It was called The Man Who Lost 50 Million.
And it was about the infamous American speculator Victor Niederhofer, a guy known for these incredible successes, followed by just, blowing up his fund twice.
Now, most people would see that and just see the failure, the risk.
It'd run the other way.
Right. But BNF saw the freedom. He was totally captivated by the lifestyle, the independence of trading. So much so, he actually based his trading name, BNF, on Victor Niederhofer.
But the odds against him were just astronomical. This is the 1990s in Japan. There's no widespread broadband internet, no online courses.
And almost no books on the topic, right?
Yeah.
The sources say there were basically zero Japanese textbooks on computer-based trading. If you wanted to learn, you were completely on your own.
So he knew the information he needed just didn't exist. He had to create it himself through sheer observation.
And that meant immense sacrifice. For 2 straight years, he's working multiple part-time jobs, nights, during the week, all weekend, just to scrape together his starting capital.
And that sacrifice is so key. It wasn't just about the money. Every single second he wasn't working, he was glued to stock charts. He was just watching price action, focusing on the top stocks in the Nikkei index.
He was literally reverse engineering the market flow, building his own theories from scratch.
After 2 years of that brutal schedule, living super frugally, he saved up $16,000. And in the year 2000, he was ready to face the markets.
And the market immediately tried to crush him.
What a time to start.
Seriously. The global dot-com bubble had just burst, which was a disaster by itself. But Japan was already 10 years into its lost decade. Asset prices were down over 70%.
It was just a relentless bear market, pure fear.
So he takes some early losses, as you'd expect, but those losses led him to his core, career-defining idea, the contrarian trading strategy.
And his big insight wasn't about finding undervalued companies in the traditional sense. It was about exploiting human emotion.
This is pure behavioral economics, isn't it?
Exactly. He realized that in a fear-driven market, people don't sell for logical reasons. They sell to stop the emotional pain. And that means stocks always oversell.
They drop way past what makes any fundamental sense.
Right. And that irrational emotional panic creates a predictable rebound opportunity that you can exploit.
So he turned that psychological insight into a concrete technical rule. This is where the moving average divergence comes in.
And for anyone not familiar, the moving average is just a baseline. It's the average price over a set period. He used 25 days, which is a short-term indicator.
Okay, so it shows you where the price should be, more or less.
Sort of, yeah. And the divergence is just how far the current price has crashed below that baseline. His primary rule was simple. Don't even look at a stock unless it's deviated at least 20% off that 25-day average.
And he had a sweet spot, right?
He did. He felt that a 35% deviation was a pretty safe level to buy in for a quick rebound, but he was still picking losers sometimes.
So he starts analyzing his losses. What did he find?
He found that the market wasn't one single machine. That deviation percentage, it wasn't universal. It changed completely depending on the sector of the stock.
So why would a tech stock behave differently from, say, a service stock in a crash?
It's all about volatility and how people perceive risk. A big, stable utility company dropping 22% is like a catastrophe. It's highly unusual.
Right.
But a volatile post.com tech stock, 25% drop might just be a bad Tuesday. He found that for those stocks, the panic could push them way further down, maybe 45% or even 60% before you got that natural rebound.
So this feel for the sector he developed wasn't just intuition. It was a data-driven understanding of the volatility profile for hundreds of different companies.
Exactly. He translated raw market mechanics into a set of rules he could actually use. And this saved him during the huge penny stock crash in December 2001.
Ah, the Black Friday sale. This anecdote is amazing. So his friends saw stocks hitting that typical 20% deviation, and they all jumped in.
They thought they'd found the bottom.
And what did BNF do?
He waited. He watched the chaos and understood that this wasn't a normal dip. When everything is collapsing, the panic is on a different level. So he ignored the 20% target.
He focused only on the extreme cases.
Only the extreme cases.
Yeah.
The really volatile stocks that were getting pushed closer to a 65% deviation.
That sounds terrifying, just waiting for the bottom to completely fall out.
It sounds like a gamble, but it was calculated patience. He was waiting for maximum irrationality. And because he waited, his timing was perfect. The stocks he bought rebounded violently. Some jumped 50%, some even doubled in just a couple of trading days.
And the result of all that discipline, by the end of 2002, that initial $16,000 had become $1 million.
An incredible run. And then came the great irony, the tragedy, you could call it.
The bull run.
The bull run. Around 2003, the global markets turned. Suddenly there's optimism everywhere, greed, not fear. BNF's entire system, everything he'd built, was basically obsolete overnight.
So he had to adapt or lose everything he'd just gained. What was the pivot?
Well, he was smart. He didn't try to fight the bull market. He realized that the Japanese market was moving up as a whole, but not all at once, not perfectly in sync.
This is where the lagger strategy comes from.
That's it. He figured, okay, when the Nikkei gets a boost, the big companies don't all jump at the same time. They move in waves. So he'd track the strongest performers and then immediately start looking for the laggers.
Companies in the same sector that just hadn't caught up yet.
Exactly. He'd buy those, betting that the rising tide would eventually lift their boat too, and he'd hold for a few days or a few weeks.
So he shifted his whole worldview. He stopped seeing the market as individual stocks and started seeing it as one global machine with all these interconnected parts.
It was a complete paradigm shift. He was doing real-time cross-sector analysis. It meant fewer trades, but the bull market stability let him use bigger amounts of capital with more confidence.
And it clearly worked. This new strategy grew his account by another $10 million in 2 years. But the moment that turned him from a trading genius into a national legend, that was December 2005.
The JCOM trade. The story is it's unbelievable. JCOM Holdings is having its IPO, and Mizuho Securities, a top-tier firm, makes the most expensive typo in financial history.
An unimaginable mistake. A broker meant to sell one share for 610,000 yen.
Which was a totally normal price.
Instead, he entered an order to sell 610,000 shares for 1 yen each.
1 yen. The market just broke. Total panic.
The stock immediately craters to the limit down price, the lowest it's allowed to fall in 1 day. And while everyone else is frozen, wondering if it's a glitch, BNF acts.
Instantly. He attacked with incredible speed and scale. He bought 7,100 shares at that rock bottom price, risking half of his entire account.
Half his fortune on one chaotic trade. That single purchase gave him a 49% stake in the company.
So Mizuho is in a full-blown panic, trying to buy back the shares. But the traders who got in, like BNF, are refusing to sell. And this is where you see the difference in mindset.
Right, because his protege, another famous trader named CIS, he cashed out right away.
Immediately. He took the money and ran, basically. He was afraid the government would step in and just nullify the whole trade.
But BNF held on. Why?
Because for CIS, it was about the money. The cash was real, and so was the risk of losing it. For BNF, it was a game. He saw it as a checkmate. Mizuho had made a colossal blunder, and he was just capitalizing on it. He had 6,000 shares overnight, totally calm.
And that calm paid off. Mizuho couldn't legally force them to return the shares. They had to settle. They agreed to buy the shares back at the original intended price of 975,000 yen.
The result was staggering. BNF pocketed about 2 billion yen in profit. Overnight, he's the JCOM man. He's a legend. And that's when Masayoshi's son started paying attention.
But the fame, the wealth, it actually had a negative effect on him. He hated it. He said he only cared about the art of trading.
And that's such a critical point. He famously said that taking out physical cash made him a worse trader. Seeing the physical amount of cash makes me fearful of how much I'm putting on the line. He needed it to stay abstract, like points in a game.
But that disciplined approach was about to face its ultimate test, the 2008 global financial crisis. And even the god of day trading made a huge mistake at the start of it.
The Lehman mistake. September 2008, he sees Lehman Brothers stock has fallen 73% and thinks, okay, bear market rules apply. Extreme deviation, inevitable rebound. He pours $6.5 million into it.
Why did his golden rule fail so spectacularly?
Because he broke his other golden rule. Never trade a market you haven't spent years studying. His deviation targets were perfectly tuned for the Nikkei, for Japanese markets. He completely underestimated the fragility and, frankly, the corruption in the U.S. banking system.
A brutal lesson. That $6.5 million just vanished overnight.
And the storm was just getting started in Japan. By October 2008, the Japanese economy was getting hammered, and suddenly BNF's decade-old deviation targets were useless. The rebounds were too fast, too volatile. He starts a long losing streak.
So he's just lost millions. His main strategy is broken. The world is ending. This is where most traders would just cash out and hide. What did he do?
This is what makes him a master. He stayed calm, he cut his losses and went straight back to the drawing board. He didn't doubt his core principles. He doubted his numbers. He knew the market structure had changed, so he had to recalculate all his deviation targets for every single sector.
He treated it like a brand new puzzle.
Exactly. And this period of intense reanalysis leads to October 27, 2008. The Nikkei is still falling, but BNF, with his new, updated targets, is ready.
So on that day, with global markets in a freefall, he sticks to his new plan.
He does. He went on an insane buying spree. He took positions in over 90 of the hardest hit companies, building an overall position size of, wait for it, $64.8 million.
$64 million.
Yes.
While the market is crashing. That's just superhuman nerve.
But it wasn't just nerve, it was calculation. He held that massive position all day. Then, after the Tokyo lunch close, the market finally started to rally. He held the entire position overnight.
A huge risk.
A huge calculated risk. The market rallied the next morning. He unloaded everything, and that single calculated re-entry made him over $12 million in profit. He not only got his loss back, but proved his mastery all over again.
And since then, has he changed?
Not really. He's maintained that focus on the art of the trade. I mean, he did diversify a bit, bought a couple of commercial buildings to hedge against inflation, but his core identity is the same. He's still chasing that original goal.
To become the world's first billionaire bare bedroom day trader.
Which brings us right back to that central paradox. He was willing to risk half his fortune on the JCOM trade because the math made sense, but he hated seeing physical cash because the sheer value of it made him fearful and hurt his discipline.
That separation. The discipline of risk-taking versus the fear of monetary value. It's so profound. And it leaves a final provocative thought for you to consider. If your greatest asset as an investor is emotional detachment, and the biggest threat to your success is realizing the physical scale of your own wealth, what does that really say about the nature of financial freedom and the pure pursuit of an art? Something to think about until our next deep dive.